The global gold mining sector in the middle of the current decade is defined by a paradox where record-high commodity prices coexist with a market that remains cautious regarding jurisdictional risk and operational execution. Within this high-stakes environment, K92 Mining Inc. has emerged as a preeminent case study in successful asset development and operational scaling. Operating the Kainantu Gold Mine in the eastern highlands of Papua New Guinea, the company has successfully navigated the transition from a high-grade junior producer to a significant mid-tier entity. The recent commissioning of the Stage 3 expansion process plant in October 2025 represents a structural shift in the company's value proposition, doubling its throughput capacity and establishing a roadmap for reaching Tier 1 production status, defined as an output exceeding 400,000 ounces of gold equivalent per annum at costs in the lowest quartile of the global industry curve. The investment thesis for K92 Mining is predicated on three fundamental pillars: an extraordinary geological endowment, a disciplined and modular approach to infrastructure expansion, and a robust social license to operate in a complex jurisdiction. The geological foundations of the Kainantu property, specifically the Kora and Judd vein systems, exhibit grades that are significantly higher than the global average for underground gold mines. This high-grade nature provides a natural buffer against inflationary pressures and operational disruptions, allowing for exceptional margins even in lower gold price environments. Furthermore, the company's balance sheet, characterized by a record net cash position and substantial undrawn liquidity, provides the financial fortitude necessary to execute the Stage 4 expansion through internal cash flows. The market's perception of K92 Mining has historically been tempered by its geographic concentration in Papua New Guinea, a jurisdiction that has seen significant regulatory flux. However, the proactive engagement of the company with the Marape administration and the local landowner associations has yielded a degree of operational stability that distinguishes it from its regional peers. The official inauguration of the Stage 3 plant, attended by the Prime Minister and the Minister for Mining, underscores the strategic importance of the Kainantu project to the national economy and highlights the symbiotic relationship between the developer and the state. As the company enters 2026, the primary catalysts for share price re-rating include the continued ramp-up of the Stage 3 plant, the delineation of a maiden resource at the Arakompa project, and the progression toward a final investment decision on the Stage 4 expansion.
Financial performance and capital structure analysis. K92 Mining's financial trajectory over the 2024 and 2025 fiscal years illustrates a company in the midst of a rapid scaling phase. For the full year 2024, the company reported record revenue of $350.6 million, a 75% increase over the previous year. This growth was driven by a substantial increase in gold ounces sold, which rose to 141,159 ounces, combined with a higher average realized selling price of $2,356 per ounce. The net income for 2024 reached $111.2 million, or 47 cents per share, representing a 235% increase from 2023 levels. The momentum continued into 2025, with the third quarter of that year delivering landmark results. K92 reported quarterly revenue of $177.5 million, an increase of 45% year-over-year, and net income of $85.7 million. The company's ability to generate cash remains exceptional. Operating cash flow before working capital adjustments for Q3 2025 was $101.8 million, or 42 cents per share. This financial performance was supported by record average realized gold prices of $3,361 per ounce during the quarter, allowing the company to achieve an EBITDA of $130.2 million.
Balance sheet liquidity and debt profile. A core component of the K92 investment case is the strength of its balance sheet, which minimizes the need for dilutive equity financing during major expansion phases. As of September 30, 2025, the company held record cash and cash equivalents, totaling $185.4 million. When offset against a debt position of $55 million, the company maintains a record net cash position of $131.2 million. The total debt consists primarily of drawdowns from a credit facility with Wera, which has played a strategic role in financing the growth capital for the Stage 3 and 4 expansions. The company's debt-to-equity ratio remains conservative at approximately 7.9%, with total shareholder equity estimated at $688.7 million. This low leverage is particularly impressive given the scale of the capital expenditures undertaken. In 2024, the company invested $167.9 billion in property, plant, and equipment, while 2025 growth capital is forecasted between $105 and $110 million. Furthermore, the company possesses up to $90 million in remaining undrawn liquidity through its Trafigura facilities, providing a significant safety margin for unforeseen operational or inflationary challenges. Cost structure and margin expansion. K92 Mining's cost profile is undergoing a transition as the economies of scale from the Stage 3 plant begin to materialize. In 2024, the all-in sustaining costs were $1,066 per gold ounce, which beat the initial guidance range and reflected the high-grade nature of the ore processed. However, costs were temporarily impacted in early 2024 by a non-industrial incident that led to a short suspension of underground operations, resulting in certain fixed costs being expensed directly to the cost of sales.
Looking forward, the company forecasts a significant reduction in unit costs following the full ramp-up of the 1.2 million tons per annum Stage 3 facility. The definitive feasibility study for Stage 3 outlines a life-of-mine average cash cost of $694 per gold equivalent ounce and an all-in sustaining cost of $920 per gold equivalent ounce. The Stage 4 expansion case is even more compelling, projecting all-in sustaining costs to drop to approximately $822 per gold equivalent ounce. These projections are supported by the use of LaTeX-formatted formulas for gold equivalent calculations, such as AuEq equals AU plus CU times 1.62404 plus AG times 0.01316, which account for the significant copper and silver co-products. This diversified metal stream provides a natural hedge and lowers the net cost of gold production through significant byproduct credits. Geological endowment, the Kainantu district. The primary driver of K92 Mining's industry-leading margins is the exceptional quality of its mineral resource. The Kainantu property is situated within the New Guinea Mobile Belt, one of the most prolific geological environments for gold and copper discoveries globally. The asset is characterized by high-grade, intrusive-related gold-copper quartz sulfide vein systems, primarily the Kora and Judd systems, which are situated parallel to one another. The mineral resource estimate as of late 2024 shows a measured and indicated resource of 2.6 million ounces at 10 grams per ton gold equivalent, with an additional inferred resource of 4.5 million ounces at 8.5 grams per ton gold equivalent.
Kora and Judd, high-grade vein systems. The Kora system remains the primary production hub, consisting of several subparallel veins, including the K1 and K2 veins. These structures are known for their continuity and the presence of high-grade dilatin zones, where the vein thickness can expand significantly. Recent drilling has consistently intersected these zones. For example, drill hole KMDD0752 recorded 13.5 meters at 19.02 grams per ton gold equivalent, while KMDD0753 intersected 10.6 meters at 34.57 grams per ton gold equivalent. Such grades allow the mine to maintain high output even with relatively low tonnage throughput compared to larger, lower-grade open-pit operations. The Judd system, which parallels Kora, has demonstrated remarkable growth since its discovery. The drill-defined strike length at Judd has expanded by over 130% since 2021, and the company is now testing the Judd Deeps target to depths of 500 meters below current mining levels. The positive grade reconciliation observed during mining, where actual grades often exceed the resource model by 10 to 15%, suggests that the current resource estimates may still be conservative. This reconciliation is a key indicator of the asset's robustness and provides a high degree of confidence in the long-term mine plan. Regional exploration and porphyry potential. While the current operations are focused on the high-grade veins, the broader Kainantu lease holds significant potential for large-scale copper-gold porphyry deposits. The Blue Lake project is the most advanced of these targets, with a maiden resource estimate completed in August 2022 that outlines a substantial mineralized system. Furthermore, the Arakompa project, located approximately 4 kilometers from the plant, has emerged as a high-priority bulk tonnage target. Drilling at Arakompa has yielded results such as 94.4 meters at 3.14 grams per ton gold equivalent, indicating the potential for a new mining center that could support a Stage 5 expansion toward 1 million ounces per annum.
The company's exploration strategy is supported by an annual budget of approximately $20 million, which is focused on both near-mine vein extensions and regional targets. As of late 2025, K92 is operating up to 12 drill rigs on site, one of the most aggressive exploration programs in the country. The density of targets within the 830 square kilometer land package supports the view that the Kainantu district is an elephant country, where the full mineral potential is only beginning to be understood. Infrastructure expansion and operational execution. The transformation of K92 Mining from a small-scale operator to a mid-tier producer is being achieved through a disciplined, staged expansion program. This modular approach allows the company to fund growth primarily through operating cash flows while de-risking each subsequent phase of development. Stage 3 expansion, doubling capacity. The Stage 3 expansion centered on the construction of a new 1.2 million tons per annum process plant, which was successfully commissioned in the fourth quarter of 2025. This facility, delivered under budget, provides a standalone crushing, grinding, and flotation circuit that operates in parallel with the existing Stage 2A plant. The inauguration of the plant was a major operational milestone, with the first saleable gold-copper-silver concentrate produced in early October 2025.
Key to the success of the Stage 3 ramp-up is the supporting infrastructure, including the development of a state-of-the-art paste fill plant. This plant is critical for the long-term stability of the underground mine as production rates increase. By pumping a mixture of tailings and cement back into the mined-out stopes, the company can maximize ore recovery and ensure the safety of the workforce. The paste fill circuit is scheduled for commissioning in mid-2026, which will allow for higher development rates and more efficient stoping cycles. Stage 4 expansion. Target 400,000 ounces. The Stage 4 expansion represents the next major leg of growth for K92 Mining, with a target to increase total throughput to 1.8 million tons per annum by late 2027. This expansion involves upgrading the Stage 3 plant and optimizing the underground mine to support higher extraction rates. The economic projections for the Stage 4 preliminary economic assessment case are transformative, with a peak annual production of nearly 485,000 ounces of gold equivalent. To support this tonnage, the company is rapidly increasing its underground mining fronts. By the end of 2025, K92 plans to have 3 active mining fronts, increasing to 4 in 2026. The installation of 2 raised bore rigs has also been completed to upgrade mine ventilation and improve productivity through the development of dedicated waste and ore passes. These technical improvements are designed to decouple the mining and hauling cycles, allowing for more consistent throughput to the mill.
Jurisdictional and regulatory environment in Papua New Guinea. Operating in Papua New Guinea requires a sophisticated approach to political and regulatory risk. The country is a mature mining jurisdiction that is currently undergoing a significant overhaul of its legal framework to ensure the state and its citizens receive a greater share of mineral wealth. The Mining Bill 2025 and State Equity. The most significant regulatory development is the proposed Mining Bill 2025, which is intended to replace the Mining Act of 1992. 24. A headline feature of this bill is the formalization of the state's right to acquire up to 30% equity in any mining project. 25. This equity is typically acquired through a deferred payment mechanism where the state's share of costs is recovered from the project's future earnings. 26. Importantly for K92, the draft bill includes regulatory stability provisions that protect existing mining leases, allowing them to continue under the 1992 Act for their current terms. 26. The bill also introduces changes to royalty rates. In cases where the state takes equity, the royalty rate is 5%, whereas it increases to 10% if the state chooses not to participate in the equity. 25. Additionally, the bill mandates that at least 50% of mine products must be offered to local smelters or refineries if they exist and are commercially competitive. 26. K92's proactive communication with the Mineral Resources Authority ensures that it remains aligned with these emerging standards while maintaining its internal rates of return. 28. Political stability and government relations. The relationship between K92 Mining and the Marape government is characterized by mutual cooperation. Prime Minister James Marape has stated that the goal of the new resource regime is to increase national benefits without harming the rate of return for investors. 28. The successful reopening of the Porgera mine and the progress on the Wafi-Golpu and Frida River megaprojects suggest that the government remains committed to attracting large-scale foreign investment. 28. For K92, the transition from a mining lease to a special mining lease for the expansion projects will require continued negotiation and stakeholder alignment, but the project's track record as a major tax and royalty contributor provides significant leverage.
Community relations and benefit sharing. The social license to operate at Kainantu is governed by a memorandum of agreement between the company, the state, and the local landowners.
K92 has been working to finalize and implement outstanding MOA commitments, including the direct and transparent distribution of royalties and the provision of infrastructure development grants. While procedural delays at the government level have sometimes caused friction with landowners, the company has proactively used the Infrastructure Tax Credit Scheme to deliver tangible benefits. The inaugural ITCS project, a $6.6 million road upgrade, was launched in May 2024 and serves as a visible commitment to local development. Macroeconomic outlook and commodity price sensitivity. The investment outlook for K92 Mining is further enhanced by a bullish long-term forecast for its primary products, gold and copper. Global commodity researchers, including those at J.P. Morgan, anticipate that gold prices will continue to be supported by central bank diversification and geopolitical uncertainty, with potential for prices to reach $5,000 per ounce by late 2026. For a high-grade producer like K92, such a price environment would result in extraordinary free cash flow generation. Copper is also expected to benefit from structural demand related to the global energy transition and grid infrastructure expansion. Forecasts suggest copper prices could reach $11,400 per metric ton in 2026 and as high as $15,000 by 2035. Silver, as a critical industrial metal, adds another layer of revenue diversification. The sensitivity analysis provided in the company's technical reports indicates that at current spot prices, the after-tax net present value of the combined Stage 3 and 4 expansions is significantly higher than the company's current market capitalization, providing a substantial margin of safety for investors.
Risk assessment and mitigation strategies. While the investment case is compelling, it is not without risks. These can be categorized into operational, jurisdictional, and commodity price risks. Operational and technical risks. The primary operational risk in the near term is the successful ramp-up of the Stage 3 plant to nameplate capacity. Any delays in commissioning the paste fill plant or tripling the mining fronts could impact throughput and cost guidance. K92 mitigates these risks by employing an experienced management team with a proven track record in PNG and by using reputable EPC contractors like GR Engineering Services for its infrastructure builds. The historical ability of the company to exceed its production guidance provides some comfort in this regard. Jurisdictional and legal risks. Jurisdictional risk remains a constant factor in Papua New Guinea. The transition to the 2025 mining bill could create a period of uncertainty regarding the exact terms of state equity participation and royalty payments. However, the company's status as a major corporate taxpayer, paying $62.6 million in taxes and royalties in 2024, and its strong community ties provide a degree of protection against adverse policy changes. The legal dispute with South Pacific Metals Corp over the tailing site also illustrates the potential for tenement-level conflict, although the company's swift resolution of the matter demonstrates its capacity to manage such issues. Commodity price volatility. As a primary gold producer, K92 is inherently exposed to fluctuations in the gold price. To mitigate this during the capital-intensive Stage 3 build, the company has historically used gold put contracts as insurance against price downside. As the company moves toward Stage 4, its increasing production of copper and silver co-products will provide a more diversified revenue stream, further hedging against a downturn in any single metal price.
Valuation. K92 Mining is currently at a critical valuation inflection point. Historically, the company has traded at a discount to its North American peers due to its geographic concentration and development status. However, as it enters 2026 as a proven mid-tier producer with the Stage 3 plant fully operational, a significant re-rating is anticipated. Catalyst checklist for 2026. The primary catalysts for the stock in the next 12 months include the consistent achievement of Stage 3 nameplate capacity, which should drive a marked reduction in quarterly all-in sustaining costs. Second, the release of the maiden mineral resource for Arakompa in the first half of 2026 is expected to be a major market-moving event, as it would likely confirm the project's potential as a secondary mining center. Third, the progression of the Stage 4 final investment decision and the continued exploration success at Kora and Judd deeps will provide ongoing evidence of the asset's longevity and scale. Strategic conclusion. K92 Mining represents one of the highest quality growth opportunities in the precious metal sector. Its combination of elite grades, low costs, and massive exploration upside is rare among mid-tier producers. While Papua New Guinea is a complex operating environment, the company's sophisticated stakeholder management and strong balance sheet provide a robust platform for the next stage of its evolution.
As the company moves towards its goal of becoming a senior producer with a 1 million ounce per annual potential, it offers investors exceptional leverage to the gold and copper markets. The successful execution of the Stage 3 expansion has significantly de-risked the investment case, making K92 a compelling addition to a diversified mining portfolio. The company's journey from a junior discovery story to a world-class operator is nearly complete, and the financial rewards for shareholders are likely to be substantial as the full potential of the Kainantu district is realized.